Welcome, ladies and gentlemen. Thank you all for connecting. My name is Peter, and I'm head of production here at Connectiva. First of all, on behalf of the entire Connectiva team, I would like to thank you all for connecting. I do hope that you will find this webinar beneficial and insightful and useful. Before we begin, I would like to ask you just to, write in the chat that, everything works, or let's do it like this. Maybe those who connected, write in the chat where you're connecting from so that we can check both if you can hear me, if everything works, and also to see who is the attendees in the at the audience. So for those of you that don't know us, we are this webinar is part of our Finance CEE network, which is the network that we're building here in the CEE region that consists of 3 communities: treasury, accounting, and tax community, and risk community as well. So if you are interested more to discover more into what we do and what kind of events we host in this network, please visit our events page on our website. So ahead of us, we have a very interesting webinar. We have a very interesting program. So we will have 2 modules, as you can see, and both modules will have 2 sessions, 1 presentation and 1 panel discussion in each module. We will start off with a very exciting update from Rafael Petruzzi about the tax and transfer pricing regulations. Then we will continue with the panel discussion on liquidity optimization in times of economic slowdown with 4 different panelists. Then we'll take a short break, and after that, there will be a second module, which is called Career and Finance. We will have a presentation from Mariana from Tenaris. She will discover the kind of explore the evolution of what is the CVO, Chief Value Officer. And then we'll finish the webinar with a panel discussion about the younger generation entering the workplace and the world of finance in general. This is a live webinar, so I do encourage you all to ask questions, to write comments in chat, and we are monitoring everything, so we will address the questions to the speaker accordingly. And the recordings of the webinar will be available later on our website next week on demand. So all of those who registered for the webinar will receive the notification. So pay attention to your mailboxes next week for the recordings. So this is it from me. Again, I really hope that you will find this webinar beneficial and interesting. So without further ado, let me introduce you to our first speaker, Rafael Petruzzi. He's the Managing Director at WU Transfer Pricing Center, and he will give us the presentation about the tax and transfer pricing regulations. Good morning, Rafael. Welcome to the stream. Thank you for connecting. Before you begin, please just say a few words about yourself for the attendees. Thank you.
Hello, good morning, Peter. Good morning, everyone. And thanks, Peter, again for the invitation to this event. Just a few words about myself. I'm originally from Italy, but I live and work in Vienna for more than 10 years now. I divide my life between academia and practice. I am, from an academic perspective, the Managing Director of the WU Transfer Pricing Center at Vienna University of Economics and Business. You see the nice campus we have in the background. So if you are around Vienna, it's worth a visit. And from the practical side, I'm an advisor on tax, international tax and transfer pricing issues. Today we will present a little bit what's going on in transfer pricing, more specifically how transfer pricing is understood from tax people and how it is understood from accounting and finance people. So I would try to clarify the differences between your understanding of transfer pricing and the tax understanding of transfer pricing, because these differences often in practice play a significant role. Then I'll give you an introduction of what is going on in around the world on these topics, and touch upon briefly on the technologies and new technologies you can use nowadays to deal with these issues, and those that you hopefully will be able to use in the future. And then have some conclusions, some concluding remarks. Feel free to unmute your microphone or text, whatever you prefer. Also, during the presentation, asking questions, clarifying issues, and of course, let me know if my English is not perfect, and so you don't understand some terminology, or you're not familiar with some terminology that I'm using. So here we go. What is transfer pricing? What do you think transfer pricing is? Actually, this is probably a big question when you ask people around what people think transfer pricing is. And most of the time I get this answer: transfer pricing is the price of goods and services that is charged between different departments, different offices, and or different entities in the same multinational. So this is a pretty good understanding of what transfer pricing is, but this is the understanding that people usually in accounting or in finance think or know transfer pricing is, which is absolutely correct. Transfer pricing is indeed mostly about the price that you have to charge when you exchange a good or a service between different departments or different entities of the same group. And this is important, of course, because all the departments need to somehow be compensated when they exchange goods or services with each other. But when you ask a tax person what transfer pricing is, well, they usually have in mind transfer pricing legislation. And transfer pricing legislation is rather the set of rules, tax rules, that a country includes into its legislation in order to avoid that a company, when transacting with another company of the same group in a different country, then would shift profits outside the country. And this is something that makes things a little bit more complicated. Not that they are simple from the accounting or finance perspective, but they get even more complicated from a tax perspective. And let me tell you why with an example. You see here, you might have a company established, a group established in the US. Here you have Apple, with a manufacturer in China, a distributor in Austria. The manufacturer buys somehow the materials that he needs in order to manufacture his phone. He sells, produces the phone and sells it to Austria for 700 euros, makes 300 of profits, and the distributor sells that phone in the local market in Austria with the Apple store for 1,000 and makes 300 of profits, and the overall group makes 600. Now, when you ask a person that works with accounting or in finance, what is transfer pricing? What do we have to be careful at? Most of the time, the question will be, okay, what is the price of this product? What should be the price of this product? And how do you derive that price? You have several approaches. Probably the most common approach in this case will be to take all the costs that you need in order to manufacture that phone, the direct cost, eventually also the indirect cost, add some markup, some remuneration for the manufacturer's activities, and then you end up with that 700. Does someone questions that 700? Not that much, because of course it is important from an accounting perspective to make things correctly, but we are talking about internal accounting here. So it is something that is important for performance measurement. It is important for eventually third-party shareholders. It is important for various reasons, but it is not the ultimate way to answer the question from a tax perspective. From a tax perspective, from a tax understanding of transfer pricing, what will be important is not only this price, but rather answering the questions whether the contract that you have signed between the manufacturer and the distributor is something that is in line with reality. Whether two independent parties would have signed a similar contract with similar clauses. Also, whether the transaction makes commercial rationality, whether two independent parties would have somehow designed the transaction in a similar way, or whether they would have structured the transaction differently. Then the question comes on whether the methodology you use is the most appropriate one, and there are typically 5 methodologies that are used in the tax world to define that value of the transaction, and it's often not clear which one should be the correct methodology to use. And last but not least, the question of whether ultimately out of this transaction, the profit, and not just the price, but the profit that the manufacturer makes, the distributor makes, is at arm's length, is a profit that 2 independent enterprises would have agreed upon. So you see, that's the reason why I say from a tax and perspective, transfer pricing is something different than what it is from an accounting and finance perspective. And that's why I believe it's something a little bit more complex, even more complex than what it is from an accounting and finance perspective, of course. So this is just for you to know when you speak with your colleagues in the tax team, that somehow you are aware that there are differences between the way that accounting and finance see at transfer pricing and the way that the tax function sees at transfer pricing. Now, what I wanted to let you know is what's going on with this issue from an international perspective. What are the hot topics? What are the discussions currently going on? What eventually you need to be careful at when you are dealing with transactions between separate departments or separate entities within the group. So this is a list that is, of course, not exhaustive, but a list that shows you what's somehow going on here. Services are very important. Services are something that are commonly exchanged almost every day within companies in the same group. And the question often comes not only about what is the price of the service, but rather what is the understanding of that service, whether you really need that services or not, whether you can charge those services to the companies or not. So this is something that is often coming as an issue in multinationals. Financing, this is a topic that, of course, all of you are very familiar with. So when you have an intragroup loan, when you have guarantees, cash pooling, factory, and so forth, when you have something between one entity and another, a flow of money between one entity and another that should generate compensation because it is something that provides a benefit to the other entity. Then the question comes often about the interest rate, for example, the remuneration for that product, for the financial product. But from a tax perspective, the question is also whether the contract, the financing agreement that you have put there is actually fine, and whether the structuring of that financing transaction is fine. Next big issue that creates often headaches is intangibles. Intangibles, something that we don't see, we cannot touch, but they are very valuable for multinationals. Think of the brand of the company, think of all the intangibles out of the R&D department of the company, think of software, think of formulas, think of all those activities. Of course, they are something that they are very difficult to understand where they are and who is doing what when referring to those intangibles. But tax administrations are putting a lot of attention to those transactions because they generate a lot of value. Business restructurings, when you move some people from one entity to another, when you are moving functions or even assets or risks from one entity of the group to another, then the company that loses those people or those functions should be remunerated in a way that a third party would have been remunerated. And of course, here, the tax administrations of that entity will carefully look into that movement. So even if you have not eventually explained that there was a movement of people or functions in your documentation, in your transfer pricing documentation, you still have to be mindful to be ready to answer questions about your movements of people and functions within the group. Interplay with customs and VAT, of course, transfer pricing interplay is useful not only for direct tax purposes, but also for customs, and on top of customs, there is VAT. So once you make something wrong from a direct tax perspective, then you might have issues also with customs and VAT. So that makes things even more complicated than what you might think if you only look at the direct tax aspects of the topic. Digitalization of the economy, of course, a lot of companies are getting more and more digitalized, including in the finance sector, but not only. So, of course, here there are some discussions now at the international level, what to do when you perform some activities in a country without having any presence. Should you pay taxes into that country? Well, normally not, because if you don't have any presence, you don't have to pay taxes typically. But governments and international organizations, tax administrations are starting putting that concept in discussion, and they're starting saying, well, if your customers are there, if your revenues are there, even if you don't have any presence in terms of a company, in terms of people, in terms of a permanent establishment, an office or something, still you might have to pay taxes into that country. And this is something that both the OECD and the United Nations are trying to solve. They are trying to come up with an answer, but it is still far away from being agreed or at least implemented into the legislation. Global mobility of workers. We've found out with pandemic that many of us can work from pretty much everywhere. So This creates a lot of headaches to companies because you might have issues of permanent establishments. You might have issues of how much profits to attribute to those permanent establishments. You might have issues with transfer pricing, business restructurings, and so forth. Not to mention, of course, all issues you might have from a social security perspective. So this sure is or will continue to create headaches to transfer pricing experts. Here, a brief overview on the case law. So what are the type of transactions that are mostly discussed between taxpayers and tax administrations? You see here a list that confirms at the end of the day what I just told you. Financing is the most discussed issue between taxpayers and tax administrations. Intangibles are also very much in the discussions. Goods and services, yes, they're there. They're not the main one, but they are still very important. And business structuring is coming up more and more in those discussions. Here, the issues that are typically discussed, you see transfer pricing methodologies, how to apply those methodologies are often there, but there are more and more discussions on who has the burden of proof, whether you have made an appropriate documentation, transfer pricing documentation or not, whether you have an interplay with general anti-avoidance rules, losses, permanent establishment, and recharacterization issues. Now, before completing, I just wanted to give you an overview on the technology that eventually are available or can be available there in order to manage those transfer pricing issues. Well, first of all, when looking at the transfer pricing life cycle, you start from planning strategies, guidelines, and eventually doing some benchmarking of the transaction. You then go into the pricing part of your analysis. You monitor those prices. You try to make sure that those prices are correctly applied. Eventually, you make transfer pricing adjustments in case monitoring those prices, you find out that the prices applied are not those that you should have applied. Then you write everything in a nice transfer pricing documentation. You make contracts, you make all in line with the documentation requirements by the tax authorities. Then, of course, you have to manage the relationships with the tax administrations. You have to discuss with them whether the outcome of your analysis are somehow in line with what their expectations are. And active management is, of course, very important. Things change often in a company, things change often in a tax world, and so you need to always be having an active management of all these issues. Now, we have a lot of new technologies available nowadays. Some companies are more advanced in using those technologies for their tax issues. Some companies are a little bit less into this topic, but for sure, in the future, we will have to use more and more technologies in order to deal with all these issues and also in order to manage our TP life cycle. What I see nowadays in the most advanced companies is that there is the possibility already with the technologies that we have now to eventually monitor the prices, in some cases even doing adjustments to those prices whenever they are not correct. Some benchmarking tools, more and more technological benchmarking tools are coming up. In some cases, you find also technology solution for compliance and documentation, but those technologies, in my understanding, are still not perfect. So you always need people that are experts on the topic in order to understand whether you are the outcome of what technology makes is indeed the correct one. So what should companies do? Just a short list for you to take notes and bring it home in order to understand whether you need to change something. Well, first of all, this is of course something that is I'm a little bit biased for, but it's extremely important to always continue to do trainings and knowledge. You should train your colleagues, your employees, because without knowledge of what is going on, of course, it becomes difficult to even think about all these issues. Then it's always important to build up a robust TP lifecycle, the ones that I explained you before, something that involves a lot of processes, a lot of standardization, a lot of clear guidance on the transfer pricing internal policies, on people, on responsibilities. I always say technologies doesn't make miracles. You need to have a well set up process, a well set up allocation of responsibilities in the company in order to make the technology, making that the whole setup and the whole process working well. And then once you have all this, you can implement technological tools whenever possible, whenever available. Please, as I said before, keep in mind that they are not yet perfect, but they are useful. In many circumstances, they are useful to deal with all these issues. And last but not least, try to prevent dispute, try to proactively engage in discussions with tax administrations. It's always better to discuss issues in advance rather than waiting the tax audit to come, because when you discuss things in advance, tax administrations are usually more open to somehow get an agreement on a solution you might find, rather than a tax audit environment where there is a constant conflict between taxpayers and tax administrations there, and it's difficult to get agreements. There's a lot of opportunities. There are a lot of tools coming up, especially in Europe, but also beyond Europe, in which you can discuss in advance with tax administrations, from the traditional rulings and APAs to more innovative tools like the ICAP program or the joint audits. Those are tools that are coming up more and more in Europe. And so please be mindful that those are very helpful tools. So here you go with my contact details in case you want to get in touch, in case you want to just follow what we are doing in Vienna, in case you want to get in touch for a transfer pricing issue you have, please feel free to email me or to contact me on LinkedIn. And now I'm happy to answer all your questions. I hope this was not too boring for you, and I kept you awake even in this part of the day.
Thank you very much, Rafael. Thank you. I have a few questions actually. Can you just go back to the TP life cycle? I have a few questions in that slide, especially. So, this is a very obviously kind of a long process in terms of, and there's a lot of moving parts. So, what, in your opinion, what do you think? In your experience, I would say, in which part of this life cycle companies are mostly struggling with, and what do you think? Why is that?
Well, I think it's a very broad question, and I think it depends on the specific company. But just to give you a more direct answer, of course, strategies and guidance often are not clear or are not agreed, or even if they are agreed, they are forgotten. Not everybody reads them, not everybody updates them, and so this is something where you struggle with. Pricing is something that every company does anyway, so they try to price their transactions in the best way possible, also because it is not just a tax, but it's also an accounting and finance issue. But monitoring the correct application of those prices is also another issue. So monitoring for sure is something where you struggle with. TP adjustments, once you are good at monitoring, then there are something that are not a big struggle in compliance and documentation. Well, I see all companies now getting compliance and documentation on issue well established. So this is something that is improving, although it's still quite an issue to set up contracts and transfer pricing documentation for every type of transaction. Relations with tax administrations are still something difficult. So if I would have to make a list of all these issues, probably I would put on top of it strategy, monitoring, relations with tax administrations as my top three.
Perfect, perfect. Thank you very much. And in terms of the future, what do you see? What the companies should prepare for in terms of maybe requirements or compliance or new regulations coming out? What do they should pay attention to?
Mm-hmm. So as I was mentioning before, I think they should pay attention to those type of issues I mentioned before. So all those list of topics, services, financing, intangibles, business structurings, and so forth. What is coming up next in the work from the work of international organization is more guidance on how to deal with the increasing digitalization of companies' business models, how to deal with remote working related tax issues. And so those are the new topics that probably will soon or relatively soon see more updates. And from a more country-specific perspective, please keep in mind that a lot of countries are updating or introducing transfer pricing regulations. So even when you think that things are going well and well set up in a country because those topics were already set up some years ago, unfortunately, countries are constantly providing new guidance, new legislations, new regulations on these topics. So this is something that constantly need to be monitored as well.
Perfect. Thank you very much, Rafael, for the presentation and for joining us. Thank you.
Thank you very much for the invitation, and we hopefully see each other soon.
Yes, yes. Thank you.
Bye, bye-bye.
All right, so we're moving for the next session, which is a panel discussion. The panel discussion will be moderated by Vladislav Sitnikov. He's the Vice President, Treasury and Wealth Management, QA Senior Management at a global US bank. And the panel discussion topic is liquidity optimization in times of economic slowdown. Vladislav, so hello, welcome. The stage is yours. So please, before you introduce your fellow panelists, just give us a few words about yourself. The stage is yours.
Hello, everyone. As Peter mentioned, my name is Vladislav Sitnikov, and I'm regional manager for a EMEA region in a global US bank, mostly working on treasury and wealth management activities. And I want to welcome everyone to our panel discussion. Today we have gathered esteemed finance professionals with diverse backgrounds and expertise to shed light on the various aspects of liquidity management and its significance in navigating challenges challenging economic conditions. Our distinguished panelists include Adrian Tudoska, the Regional Finance Director at Medicover, Julia Fodor, the Director of Treasury Department, CEE Center and Bank of China, Hungarian branch, and Laura Elena Simeonescu, the Head of Finance at Global Treasury, British American Tobacco. Throughout our discussion, we will delve into the impact of the global regulatory landscape on companies' ability to manage liquidity effectively. We will explore the challenges and opportunities presented by stress testing for liquidity and recovery and resolution planning. Additionally, we will delve into the strategies that treasurers employ to manage interest rate risk and optimize liquidity, as well as examine the influence of geopolitical and macroeconomic developments on corporate liquidity. With our panelists' diverse perspective and insights, we aim to provide you with valuable knowledge and practical strategies to optimize liquidity in such times of economic slowdown. So let's begin this engaging informative discussion on liquidity optimization. And Laura, how does the current global regulatory landscape impact companies' overall liquidity management strategies and their ability to navigate economic slowdowns?
Hello, everyone. I hope you can hear me. To answer your question, Vladislav, I think regulatory landscape significantly influences liquidity management strategies. Market turbulences and times of economic slowdown can create a domino effect on the economy. So regulations play a key role in one, maintaining adequate liquidity in the market, and two, containing any disruption. For example, in 2020, when the virus in China started to spread, the liquidity instantly dried out for a couple of months before the regulators intervened. At that time, we were funding ourselves in the market and we started to see signs of deteriorating liquidity. So we started to put scenarios in place. Some corporates even had their RCF drawn, their loan, just to be on the safe side, thus increasing pressure on banks. As expected, regulators injected liquidity in the economy, and whilst the crises were still there, the liquidity did improve. And more recently, when signs of distressed banks started to show up, it was more important than ever that the crisis had to be contained fast. And we did notice speed in decisions to achieve this. Having said that, it's crucial for the regulators to be properly balanced so that they achieve the main goal, which is to promote financial stability. Too tight regulations could have the opposite effect, restricting credit availability and limiting liquidity support. In summary, regulations can have a significant impact on economy. The right balance is needed to achieve financial stability, which is their ultimate goal.
Thank you, Laura. Your insights have been enlightening. Now let's hear from our next speaker, Adrian.
Yeah, so hi everyone. I hope you can hear me well. Yeah, continuing in Laura's perspective, I do believe that the regulator's main goal is to give a bit of perspective on the market and to put a bit of confidence all across. So Laura was mentioning about the injection of liquidity in the last couple of years. Yes, we saw it. Some of us were really taking advantage of it. Now we are seeing the other type of movement happening. I think we are now in a quantitative tightening period. So from my perspective, regulators should be the ones that really are calming down the macros, the companies, and for sure they are really able to influence what businesses are doing. For example, now I think with the new rules in place, with the, let's say, much more tightened conditions, companies are much more are paying much more attention on how they are deploying the capital. So yeah, for sure, regulators and rules are really critical factors for managing our businesses today.
Thank you, Adrian. Highly appreciate it. Yulia?
Yes, good morning, everyone. So I'm representing here a sector for who liquidity management is really the core business. And as such, we are pretty strictly regulated. So there is a European framework called ILAP, which stands for Internal Liquidity Adequacy Assessment Process. And actually, this framework proved to be very efficient in the past difficult times to navigate through the difficulties in liquidity management. So the number one pillar of this concept is the liquidity coverage ratio, which requires banks to maintain sufficient high liquid assets to survive 30 days under stress scenarios specified by authorities. Another important EU requirement is to have a net stable funding ratio, which is naturally the available stable funding divided by the required stable funding. So this is basically the European concept. When we go a bit west, actually the UK jurisdiction is a bit stricter. So besides the Pillar 1 requirements, they also require Pillar 2 liquidity, which contain the elements not covered by the Pillar 1 requirements, such as intraday liquidity or debt buybacks or non-margined derivative trades. And on the other side of the regulations, we can find the US jurisdiction, which is a bit lighter than the European. So for instance, the small financial institutions are exempted from the LCR requirements. And actually, we have seen in the recent past some bank failures, partially because of the non-existence of these requirements and because they did not respect these requirements, such as the Silicon Valley Bank or the First Republic Bank or Signature Bank. And actually, I expect that regulators may impose further requirements on the back of these US bank failures. So maybe they will extend the UK Pillar 2 requirements to European banks as well, or to impose some shorter dated liquidity coverage ratios, for example, 7-day LCRs, which actually I personally recommend to implement regardless of whether there is a regulatory requirement to keep that or not, because after all, I think it is not the supervisors, but each bank's own responsibility to maintain a stable operation.
Thank you, Yulia. Next, dear panelists, please share your experience. What roles does effective liquidity management play in ensuring financial stability and resilience for companies in uncertain economic times? Maybe we can start with you, Adrian.
Yeah, can you just please repeat a bit the question? Sorry, I had some issues with my headphones.
Yeah, sure. In your experience, what role does effective liquidity management play in ensuring financial stability and resilience for companies in uncertain economic times?
Yeah, sure. Thank you. Yeah, it's really crucial, and I will get back to 2020 when suddenly we have a part of our business is a kind of a retail business. So we are face to face with our customer, and suddenly from one day to the other, our business dropped to 10% from what it used to be. And we were looking into our bank accounts and say we had that X amount, and we were monitoring it on a daily basis. We were planning it like we never did before. So these uncertain times really made us better in monitoring, made us better in assessing the needs, made us better in quantifying much better our cash flows. So I think for us, and not only for us, for the whole industry, this was a really good lesson in really monitoring much better our liquidity and deploying it to really good projects. Other lessons that we've learned is that we should really leverage much better the available technology in order to better monitor and faster and have a much more in a real time analysis of our liquidity. Speaking from a person that is supervising a region, sometimes the lack of some proper systems might get you a bit in trouble, not having the full info ready, available, and live. So yeah, a good let's say some really good learnings that we had from the last couple of years.
Thank you, Adrian, for sharing your great experience. Now let's proceed with our next speaker for further perspectives. Yulia, what is your view on this? What is your experience?
Yeah, so I think that stability and resilience is really of utmost importance in turbulent times. Investors have a tendency to have a preference for stability over high yields in this environment. And so when it comes to banks, I think that the banking business is really about maturity transformation. And so in a traditional banking model, banks fund themselves, actually their long-term loans from shorter dated deposits. And I think this is really traditional banking. And I think these types of risk can be bared by the banks easily. But I would also come back to the recent US bank failures. So while I think it is okay to have unhedged exposures in the customer loan portfolio of a commercial bank, these banks had over 50% of their exposures, of these exposures in the liquid bond portfolio, which is, for the least to say, unusual and very far from being prudent. It might be okay for a traditional investment bank, but for commercial banks, this is really not, I think, the proper approach. And yes, we all understand that maintaining a higher liquidity buffer may not be the most appealing tool to ensure proper liquidity, because this is eating up our margin. But one needs to admit that on one hand, in turbulent times, it's necessary in some extent. And the other thing is that there are other powerful liquidity management tools that one may consider for the purpose of ensuring stability. We can diversify on our funding base. And actually in the UK, this is a pillar 2 requirement, not to have a high concentration. Or we can reduce our surplus liabilities by increasing customer business. So this is also a very natural tool to increase liquidity. And even we can implement a more accurate management reporting system, so that can also help to be more efficient in liquidity management. So I think these actions could all improve resilience without hurting our earnings.
Thank you, Yulia. Laura, could you please share your experience on this?
Sure. I mean, I totally agree with both Adrian's and Julia's perspectives. Crises were not just planned for, unfortunately, the crisis management, but we had to live them. And the liquidity management is always high on a treasurer's agenda, but in times of uncertainty, adequately managing liquidity becomes critical. It's about ensuring there is sufficient cash available to meet financial obligations, to make sure, I mean, in uncertain economic times, the business is under pressure. Volumes are down, collections may be down. By maintaining sufficient liquidities, companies can avoid defaulting on payments. Maintaining credit worthiness is about maintaining business continuity and preserving reputation. So yeah, by prioritizing liquidity management, companies can position themselves to navigate economic uncertainties, to sustain operations, and emerge stronger throughout the crisis.
Thank you, Laura. And we already have one question from the chat. Let's respond to it before we will move next. The question is, did you have any experience with automated funding capabilities? Anyone wants to share your experience on this?
Automating funding capabilities in term, do you mean like tools that can automatically provide funding? I think the market is not there from my perspective, at least. If I'm missing anything, just let us know. We have seen providers that are starting to try to create a sort of automated platform in commercial paper area, which is lagging compared to FX, for example, where we trade hundreds of billions yearly. In commercial paper, and everything is automated. In commercial paper and in funding, everything is more manual. We have seen steps towards automation, but I guess because this market is about putting face-to-face investors and sellers of papers, the pricing needs to match at some point, and there's a lot of discretionary and negotiation in that element, which is why it makes it a little bit more difficult.
Thank you, Laura. And now I want to discuss about stress testing for liquidity and recovery and resolution planning. Julia, how do companies approach stress testing for liquidity, and what methodologies or models do they employ to identify potential vulnerabilities and risks?
Okay, so I would not aim to reinvent the wheel here. So I would rather take the UK regulatory guidelines as a basis and just add some comments on some of its elements. So first of all, they require stress tests to address severe but plausible scenarios. They also require to focus on just key vulnerabilities. And it also makes sense that they require to perform stress tests on a regular basis. So I think monthly stress scenarios is definitely something that one shall meet. And they also have some guidelines on what types of shocks we have to stress. We have to stress for unforeseen name-specific stresses, so those stresses that are specific for the firm itself, also for market-wide stresses, and also for macroeconomic stresses. So there is a supervisory statement number 24/15, and it has a list of 14 elements which shall be included in the stress test. So I would pick up a few which I think are particularly interesting in the current environment. So one of them is that actually regulators expect a runoff factor on retail and small and medium enterprises deposits to be between 3 and 10%, while this runoff ratio, this runoff factor is 100% on wholesale deposits. This is because they consider that retail deposits are much more stable than wholesale deposits because large corporates and financial institutions are pretty much well covered with banks, so they can move their deposits from one day to another for a higher interest rate. But I think, in my opinion, and taking into consideration what happened to Silicon Valley Bank, where $40 billion were moved out of the bank within 48 hours. So if you calculate that, that's $1 billion per hour. So I think the retail runoff factor is worth to be revisited in each financial institution. The other one is the correlation and the concentration of funding. So in the previous question, I already mentioned the importance of diversifying the funding pool. I would just like to re-emphasize here. And the funding tenors. So here, there's not much detail about the funding tenor in the guideline, but one thing I think people should think about is that the behavior tenor does not equal the contractual tenor for deposits. So because of possibility of breaking the deposits or rolling them over, very often the contractual maturity of the deposit is very different from the behavior the deposits. And the last element I think I would like to mention is the intraday risk, which is gaining more and more importance because of the instant payment systems established. So in Hungary, the instant payment system is already here and mandatory for transfers below 10 million HUF. So the transfer shall be made within seconds, and the European Union is also considering establishing the instant payment system in the Eurozone as well. So all in all, I think that the PRA scenarios provide a fairly comprehensive coverage of all the possible directions from which a stress may arise. What one needs to really think over is how these assumptions translate to their own firm's characteristics.
Thank you, Julia, for your insights. I believe it provides valuable lessons for our audience. Adrian,
yeah,
what do you think?
So yeah, I'll try to move from a non-banking perspective and to share a bit my let's say my business perspective. So we are running a business which is having two main components. We have a B2B and the B2C segments, and what we did lately in order to assess much better our liquidity position, how we the scenarios that we faced, we split much let's say thoroughly our portfolio per industries, per different type of segmentations in order to match a bit the current macro environment. To give you some examples, in some of our geographies in B2B, we are exposed to sectors that are suffering a bit. So we are constantly looking to shift or to balance our portfolio in such a way that the future cash inflows are not affected. B2C wise, we are also trying to balance it a bit more, because in some other geographies where B2C was really strong, where we had like very good cash collection, so it was like zero creditor base, so we were just collecting directly from our customer on a retail basis. When the pandemic hit us, suddenly we lost that let's say most profitable and most cash generating unit of our business. So what we are trying to achieve now from a stress testing perspective is to balance our portfolio as much as possible in order to provide the business with the necessary liquidity that we need. I won't go onto the treasury side of the business necessarily. I wanted to touch base more on the let's say purely operational aspects that we are trying to have in order to keep us really safe, because having also some let's say strong exposure on so we're having a pretty sizable net debt to EBITDA ratio now, so we have some things to watch out, and we really need to be really prudent not to bypass some gearing ratios, and that's why we are always monitoring and trying to balance our portfolio.
Thank you, Adrian. Definitely adds a different perspective, different angle to our discussion. Thank you. Laura?
From our perspective, we should be stressing both sources and uses. This is what I would add to what my colleagues have mentioned. When it comes to uses, we should project cash flows on various horizons. We have a daily short-term cash flow forecast and a monthly mid-term cash flow forecast, and we balance the long-term liquidity need and the short-term liquidity need. We should also stress the projections and as Adrian was mentioning, and conservatively incorporate any sensitivities. But also when it comes to sources, we should assess the reliability of each source. As I mentioned, we've witnessed the dry out in the CP market, so that tends to be considered as you can't really count on it in a stressed scenario, so you have to be prepared. We've put alternatives in place. For example, we have committed bilateral loans on top of the committed RCF facility, which acts as a safety net. It's important that the sources of funding are diversified in terms of currency, geography, duration. And lastly, we should match, as I said, long-term gaps with long-term debt, short-term gaps with short-term debt. We also have certain metrics. For example, we do not want more than a certain amount of debt to mature in a certain year. These would be few recommendations I'd make to make sure vulnerabilities are properly assessed.
Thank you, Laura. And next, I want to discuss about hedging or the diversification strategies, how to manage interest rate risk in particular. So what are the main strategies or instruments that treasurers can employ to hedge against interest rate risk and optimize liquidity management with the current interest rate environment? Adrian?
Yeah, so I will try to be short on this one because my fellow panelists are much more experienced in this area. So what I'm for sure you have the usual let's say hedging tools like forward contracts, swaps, and all these tools that are available on the market. What I've seen lately as a trend, and maybe my colleagues can confirm or not, is kind of a switch in many companies from a variable interest rate exposure to a fixed rate on a relatively short term. So, but again, depends a lot on the risk appetite of each company. So I have colleagues that they are just not hedging. So I think it's such a matter of option. I'm not from the banking industry, but yeah, probably we had some learnings during the last couple of months about not properly hedging or not properly managing the risk in your portfolio. So yeah, in summary, I don't want to keep the time from the real specialists on this topic. So yeah, that would be from my side. Thank you.
Thank you, Adrian. Yulia, how do you hedge interest rate risk?
Yeah, so usually I provide lots of advice on that for corporates, but I think in this panel, Laura can give more insight on from her perspective on how corporates tackle this. So I would stay with how banks tackle this question from the banking book's perspective. So actually, interest rate changes are really a factor that banks are directly linked to. So they have to be very conscious about how a yield curve change affects their business. And to be honest, the current stagflation setting with inverted yield curves is not an easy one. So when we see inverted yield curves, it always signals that there are instabilities on the market. And with the stagflation setting, there are vivid conversations among monetary policy makers about whether they should continue tightening to fight inflation, or if they should worry more about the economic slowdown and cut rates accordingly. So actually, this morning we received the news that that Germany turned into recession during the winter after the revised numbers. So in uncertain times, I would say that as a general rule, we should avoid making assumptions about the future as much as we can. And we have to try to create shareholder value by having a clear view on how the firm will react to each possible future scenarios. So what we can do on our end is to establish a set of good proxy metrics, which enable us to gauge our overall position, to run proper stress tests with different interest rate shocks, assess the impact of these stress events on the established metrics, and to really decide on our risk appetite. So when we have all these in place, I think we are in a pretty good shape to have a clear view on what our interest rate exposure is and what is the percentage of the risk that we would like to hedge. So in the current interest rate environment, I would highlight maybe three things. So one of them is securing a more stable and diversified funding pool than usual is really important to protect from the risk of bank runs. One other thing is that we should remember paying attention to the effect of the discount factor when we calculate the present value of our balance sheet. So this is something that was less relevant in the low interest rate environments, but this is now really hurting our net interest margins in the denominator. And last but not least, it's important to apply the same behavioral tenor for interest rate risk and liquidity management, which may sound obvious, but from what I've seen in several banks, this is not always the case.
Thank you, Julia. Laura, could you please share from your perspective?
Yeah, I'd say the first thing to start with is to create a policy with clearly defined objectives. Optimal fixed float mix can be different depending on some company drivers and some market drivers, which is why each company needs to define their own objectives. From a company perspective, the optimal level of fixed float debt mix can depend on risk appetite, as Adrian was mentioning earlier, how leveraged the company is, if there are covenants, the level of cash the company owns, if the company has the ability to pass through inflation, or if its activity is correlated to the economic cycle or not. Also, there are market drivers that need to be monitored. The absolute level of rates, the steepness of the curve, is it a good entry point to float more, to fix more, the expectations versus the current price. In terms of instruments, we do have the classical derivatives, interest rate swaps, options, swaptions. There are also derivatives that manage refinancing risk, hedging future issuance via forward starting swaps, treasury locks. One thing to remember is we can use the debt instruments to manage the interest rate risk, i.e. issue floating notes if you need more floating, or perform a liability management exercise to lock in attractive interest rates and take out the risk of your future refinancing volumes. This is in a nutshell my view on how we should be looking at managing interest rate risk.
Many thanks, Laura, for your insights. And now let's switch to even more complex topic about the impact of geopolitical and macroeconomic development on corporate liquidity. How do changes in global macroeconomic conditions, such as inflationary pressures or exchange rate volatility, affect corporate liquidity? And what steps can business take to adapt to these changes? Laura?
So inflation can have a double effect on companies' profit and cash flows. Firstly, an effect on the cost of inputs, raw material, labor, and secondly, the level of nominal interest rates is directly affected by inflation. We have recently witnessed the unitary effort of the central banks to hike rates. Therefore, naturally, this has added even more pressure on profits and cash flow via net finance cost, especially on the highly leveraged companies. Moreover, the interest rate differentials and the flight to safety have triggered volatility in FX too, increasing even more the pressure on liquidity. So as a reactive measure to manage liquidity, there are, of course, the measures that we've discussed, stressing liquidity, diversifying sources, but there are also a set of pre-event measures that could be taken. For example, having the right FX risk management strategy in place, or a commodities risk management framework. They do help. This program will give the time to the company to fund at the right time and at the right price. And companies that have these programs in place are more resilient and can maintain a competitive advantage for longer. This is what I would recommend for a company to protect against this type of shocks.
Well said, Laura. Thank you. Adrian, what do you think about this?
Yeah, so I think this question is really matching what happened to us in the last couple of years. So regarding the geopolitical, let's say, impact, trade disputes. So what we've learned is that we really need again to make sure we have. So I will go much more into the business side of the problem. We really have alternatives available. So let me give you some examples. We had some very important suppliers back in 2020, which were having their headquarters in the northern part of Italy. Guess where the pandemic broke out in Europe first. So we had some really big supply chain issues. So no raw materials, no alternative, no cash inflows, no potential to sell to our customers. So I think what this period taught us is to again try to shorten a bit the value chain, try to be closer to your potential suppliers, and yeah, be much more careful when choosing your partners. So sometimes, and I think this is a lesson that everybody learned during the last couple of years, because we were all kind of jumping mainly into the other geographies to absorb raw materials or other products that we were needing. So the trade disputes, the geopolitical instability showed us that in order to comfortably maintain our liquidity, we need to balance again the portfolio of our suppliers, and to manage much better the supply chain, which was really a big issue for us.
Thank you, Adrian. Thanks a lot for your insights. And Julia, what is your thought about this? You're on mute.
Sorry. So yes, in principle, the rising interest rates or the macroeconomic conditions should favor the banks, because it has a positive impact on the bank's profitability by increasing the net interest income of the bank. But on the other hand, yes, the geopolitical situation is posing challenges in the liquidity management, and I think that the extra buffer gained from the high interest rate environment should be used to prepare for covering a potentially higher challenge to find liquidity resources, especially in a setting where retail deposits are shrinking due to inflation, and this is especially true in the CEE region. Actually, in Hungary, I think 80% of the population does not have any savings anymore. So this is a dramatic number already. One of the ways to proactively manage the situation, I think, is to establish key risk indicators which can serve as early warnings. A possible framework for this is to monitor the metrics already required by the regulators, so such as the net stable funding ratio, the customer loan deposit portfolio, the liquidity coverage ratio, or the survival days. We can also add some other types of metrics, like the percentage of high quality liquidity assets compared to the entire balance sheet, or compared to the total deposits. Or we can monitor the top 20 deposits compared to the total number of deposits. So once we have these key metrics in place, I think we can add the monitoring frequencies to them, and most importantly, to assign thresholds for these indicators, which will define the quality of the level of this indicator. So let's say we can put them in green if they meet a certain range. If they fall in another range, they will be yellow, or red if they reach a critical value. And so this will give the institution a clear view on how long they can carry on business if they have no longer access to external sources of funds. And then we can determine the liquidity buffer accordingly. I think this is especially a powerful tool in uncertain environments, without the necessity of making assumptions on the future, but actually it can also be very well used in less turbulent times. So I strongly recommend to have such a framework in place in every bank, and obviously not with the same metrics, but the principles could be applied in corporates as well.
Thank you, Julia. Thank you. And we have one more point. I have one more question on my list, but we are running out of time, so I would ask our panelists to be very quick if possible. For such a complex question, in what ways can treasury departments collaborate with other functional areas such as risk management or supply chain to effectively manage corporate liquidity in light of geopolitical and macroeconomic uncertainties?
Yeah, so if you don't mind, I would take this one, and I would
please.
carry on with my previous previous framework in the previous question. So I think this key risk indicator system that I just mentioned is also efficient to embed the liquidity management strategy into the business. So we can report these metrics to the management, and so we can have an action plan approved by the management based on that, which can be shared across the organization and implemented in all the affected departments. Just to give an example, so if, for example, the loan to deposit ratio goes above 85%, the bank can launch, the business departments can launch a campaign to attract more customer deposits. So we can think about things like these. So in this way, I think the entire bank will have a viable balance sheet for the foreseeable future, and is secure to operate under any market conditions together with all the departments.
Thank you, Julia. Adrian?
Yeah, so I think somehow I addressed a bit part of this question in my previous answer. So I think a very strong cooperation now with the supply chain, procurement, or all these departments is key. We need to shorten a bit the value chain. We need to be really closer to our let's say geographies. And I think from this perspective, from a macro perspective, the region that we are part of, so CEE, is having like a huge potential on further developing because we have here all the relevant tools to take advantage of the current situation. So yeah, but a very, very strong cooperation with procurement and the supply chain, I think it's key in order to properly maintain and to keep under control the liquidity and the going concern of our businesses.
Thank you, Adrian. Laura?
From my perspective, communication is the key. I think all of the departments are involved in a part of the process. Finance and accounting need to communicate about the sensitivities in the exposures. The sales need to communicate about the revenue and look at the pricing strategies. The risk management is looking to perform risk assessment, scenario analysis. The operation and the supply chain will look to optimize the capital management, the working capital management, inventory levels, payment terms, the collections. So to conclude, it takes a full orchestra to play a symphony.
Very well said. Thank you, Laura. Many thanks. With this, in closing, I would like to express my gratitude to our esteemed panelists, Laura, Adrian, and Julia, for their valuable insights and expertise in discussing liquidity optimization in times of economic slowdown. Their diverse perspectives have provided us with a comprehensive understanding of the impact of the global regulatory landscape and stress testing for liquidity, hedging strategies, and influence of geopolitical and macroeconomic developments on the corporate liquidity. I hope that the knowledge shared today will empower our audience to navigate liquidity challenges effectively and make informed decisions in uncertain times. Thank you all for joining us in this insightful discussion. Thank you.
Thank you very much.
Thank you for the invite.
It's a pleasure.
All the best.
Thank you all very much. And Vladislav, thank you very much for moderation.
Thank you. Thank you, Peter.
Okay, so we're going to take a short break, and after the break we will have a second module which will focus on the topic of career in finance. So we will look into the presentation by Mariana Coman from Tenaris. She will discover the evolution of CFO to CVO. And then we'll close the module with the panel discussion about the Gen Z in finance. So stay tuned, enjoy the break, and we will be back at 11:35. Welcome back, everyone. So we are starting our second module, which will focus on career in finance. And the first session is the presentation by Mariana Monica Coman. She's the Administration and Finance Regional Director at Tenaris. And Mariana will give us the presentation about the evolution of CFO to Chief Value Officer, a new leader of revenue generating operations. Hi, Mariana. Welcome to the stream, to the webinar. And before you start presenting, please just give us a few words about yourself. Thank you. Over to you.
Hello, Peter, and thank you very much for the invitation. I'm Mariana Coman, as you mentioned. I'm the Administration and Finance Director for Tenaris operation in Romania and CIS area. And I'm coordinating a team of 17 persons and a very, let's say, multicultural team from this point of view. So thank you again for the invitation. So if you all agree, I believe that we can start with the topics that you were mentioning. Only a second to share the screen. As I was mentioning, Tenaris, it's a global company present in 25 countries. Last year, revenues were around $12 billion. So I'm glad to be inside this team, and moreover, also to present the topics that we have on today's agenda, and especially in the current business environment with a lot of changes and processes that have taken speed in the last 3 years. We are seeing new jobs that are appearing on the market. We are seeing digitalization that was taking speed in the last years. I believe that it's important to talk about an important shift taking place in the role of the CFO or Chief Financial Officers. But today's agenda is comprising of the following points: a more holistic view of what CFO should do now, a shifting the corporate conversation towards long-term creation, identifying the key value drivers within the organization, then as a natural, let's say, continuously expanding the scope of financial departments. And as a solution, we are going to discuss about integrated thinking and reporting as a feasible alternative. As I was mentioning, in this rapid changing business landscape, the traditional focus of the CFO, it's on financial aspects and compliance is no longer sufficient. CFO must now embrace a broader perspective encompasses comprehensive value creation and protection. Because the time is changing, I believe that also the role of financial departments and also the CFO has to change and has to adapt to the new environment. We find ourselves in a world where the organization faces multiple challenges, and we need to assess various aspects of the capitals: human, social, intellectual, natural, etc. And the role of CFO is becoming crucial, and it must recognize the significance of this shift and to adjust their mindset. The role of current CFO is evolving, is taking a shift into that of the Chief Value Officer. The new role of the Chief Value Officer demands a departure from the narrow confines of financial metrics to a broader understanding of value creation. CFO are becoming vital drivers of long-term sustainable growth and success within their organizations. Let's remember that the CFOs are not acting alone. They are not acting as isolated individuals. They are driving teams, and their teams in their role are influencing the rest of the organizations. So embracing a new approach over the chief value officer is triggering, let's say, multi-dimensional effects inside the organization. And as chief value officers, I believe the CFOs have the opportunity to champion the holistic value creations. Their role is increasing in collaborating with the other stakeholders, such as boards, management teams. And they have the chance to integrate a multi-capital lens into performance evaluation. The new CFO or the chief value officer is having a 36-degree over the business, and the finance professionalism, let's say, it's becoming a key strategic driver inside the organization. We are now discussing of a new status of the CFO. It's a modern CFO that acts as a strategic leader who drives direction inside the organization while leveraging financial data and analytics in an increasing, let's say, new, let's say, environment of the business. And this is triggering, let's say, a perception over the CFOs are seen inspirational, driving for long-term value leaders, who is pushing and also implementing digitalization of finance, becoming strategic leaders. We are seeing now in today's business environment that we are discussing about sustainable action, sustainable development, digitalization, in compressing on the same umbrella the part of the financial with the part of the environmental and the social part. So the challenges facing the CFOs are to transform the finance function into something more accelerating, into something new that is involving the part of the technology, the race for the talent, because this is an important aspect, the human resources that are inside the organization. Everyone is seeking for talents in order to increase the performance as whole of the organization, and to rethink the part of outsourcing and co-sourcing models. To sum up, the CFOs must adapt to a more holistic view of their roles. We are discussing also about the change in the mindset, the chief value officer mindset, and has to consider the multiple dimension of the business, protection especially, value creation, and all this has to drive for long-term sustainable growth and to gain, of course, advantage for their organization. So to close, let's say the topic, even though also in the next topics that I'm going to tackle, the idea, let's say, it's flowing from this role of the new chief value officer to other points related to value creation, sustainability, integrated reporting, integrated thinking. So let's embrace this evolution and redefine the CFO's role as strive for value creation. To continue on the same path, I would say that it's important to highlight another crucial aspect of corporate discussion that is gaining momentum. The shifting the corporate conversation towards long value creation. As I was mentioning, the things are changing and we are witnessing to a crucial aspect of corporate discussion that is gaining momentum. The shift towards long-term value creation in the current perspective of the business. If we are looking to the past, the world was more concentrated on short-term gains, having often taken precedent. It is essential to redirect our focus towards sustainable, enduring success for the organization. We need to have another approach. We were discussing about, I was mentioning about the change in the mindset. As well, now we need to pass from a backward look to something that is more aligned to the present and the future, a forward looking of the business. Because for far too long, the corporate conversation has revolved around profits, quarterly, annual profits, and immediate gain. Of course, while these short-term metrics are important, they can sometimes overshadow the broader picture of value creation that is embedding not only the financial returns, but also the social and environmental aspects. To bring out this shift, we must recognize the interconnectedness between financial performance and other aspects of the value creation. Currently, we can see what is happening in the world: climate change, CO2 footprint, war, all these aspects that we are really living and feeling the consequence of this phenomenon. We need to embrace a more holistic approach that considers the long-term consequences of our action, taking into account the impact on stakeholders, communities, and of course, the environment. As leaders, becomes the responsibility to reshape this conversation and instill a mindset that values long-term value creation. We are now shifting from a short and medium overview, let's say, or focus, to long-term value creation that encompasses the part of the financial with the part of the environment and social aspect. What we need to do further in our businesses is to prioritize sustainable practices. Sustainability, sustainable developments are becoming keywords in the current environment. Besides that, we need to be responsible in the usage of resource management and ethical decision-making. This means considering the social and environmental impacts of our action and integrating them into our corporate strategies. The benefits of shifting the corporate conversation towards long-term value creation are manifold. It ensured the resilience and longevity of our organization, meaning that the businesses are thought on long term, are thought to be sustainable, and the consequences of our businesses have to be, let's say, integrated on long-term perspective. And of course, it helps also to attract and retain top talent. I believe that one of the main objectives of the companies is this one, related to our human resources and to our talents. In conclusion, the time for sure has come to shift the corporate conversation towards long-term value creation by embracing a holistic approach and considering the broader impacts of our action. We make sure that we are assuring the enduring success of our organization, where financial prosperity goes hand in hand with the social and environmental well-being. And I believe that this action have to come top bottom and top down, and especially we have to make also the shift from the large organization mindsets to the individual, because each action of our own, it's having an impact over the part of the environment and communities overall. Discussing about the values, here I'm pointing out the main values of our organization: health and safety, environment, innovation, our people, community relation, government, and ethics. And I believe that these values should be on agenda of every one of us in order to move forward to a more sustainable future. Going further to another important topic, it makes sense to discuss a critical aspect of organizational success: the identification of key value drivers within our organization. As I was mentioning before, the organization, the companies are focused more and more on profits and also integrating the part of social and environmental aspects in their day-to-day operation. Sometimes we are forgetting about the drivers within the organization that is leading us to this objective. In a highly competitive business landscape, it is essential to understand the factors that are truly contributing to our overall value creation and growth. In order to be on this journey, we need to identify these key value drivers, and we need to start assessing, to do a comprehensive assessment of the organization, which involves, of course, an examination of our core processes, resources, capabilities, and competitive landscape. It requires us to evaluate both internal factors such as operational efficiency, talent development, and innovation, as well as the external factors, including market trends, customer needs, and of course, regulatory influences. Of course, now we need to point out the fact that these drivers may vary depending on the nature of the business, industrial dynamics, and of course, strategic goals. The identification of these key value drivers allow us to allocate our resources, time, and efforts strategically, because otherwise, if we do not have a clear strategy how to tackle these points, it's going to be very hard to arrive to the objective that we have proposed. As taken an example in a technology company, the key value drivers might include research and development, intellectual property, and customer satisfaction. In a manufacturing company, as is the company where I work, operational efficiency, supply chain optimization, and product quality may be key drivers, because depending on those drivers, we are going to take the decision accordingly, so to fulfill our objective. Identifying the key value drivers enhances our ability to measure and track our progress. We need to establish relevant performance metrics and KPIs to monitor the impacts of these drivers on all over our value creation. This is enabling us to gauge our success, to identify, of course, area of improvements, and give us time to make necessary adjustment to our strategies and operation. This process, at the end of the day, promotes a culture of continuous improvement and innovation within our organizations. By regularly evaluating and redefining our key drivers, we stay responsive to market changes, evolving customer needs, and emerging opportunities. Today, more than ever, we cannot stay in a flat zone and in a zone of comfort and to wait, because the speed of meaning the changes are taking place rapidly, and we need, of course, to react. So for this reason, we need to foster an environment that encourages creativity, collaboration, and adaptability, of course, ensuring our long-term viability and success. In conclusion, the identification of key value drivers within our organization is an essential step towards achieving sustainable growth, sustainable development, and success. By understanding what truly drives value creation, we can focus on our efforts in order to allocate resources effectively and make strategic decisions at the end. So, in order to close the discussion on the key value drivers, it's important to embrace a culture of continuous improvement and innovation. By doing so, we position ourselves at the forefront of our industry, ready to seize the opportunities that lies ahead. Of course, in any crisis, because usually we have period of growth and period of crisis, but every crisis has its own opportunity. Someone is gaining, someone is losing. So in order to have clear strategy how to tackle this kind of moments, we need to be able to take advantage of each situation. And I believe that the part of identifying the key value drivers, it's an important part of this journey. Now that we have discussed, we have started from the role of the CFO, the new role of CFO, we have passed to the part of the value creation and identification of the key value drivers. It's important also to shed light on the significant trend in reshaping the role of the financial departments within the organization and the expanded scope of their responsibility in this business environment, exploring what this means for business leaders when viewed through the lens of sustainability. So we cannot have an isolated view over the financial department, because the financial departments are evolving, and in the same time also the importance of this department, let's say, is differently perceived. In the past, the financial departments primarily focused on the transition function, such as accounting, financial reporting, and budgeting. However, today, in today's dynamic business landscape, the scope of the financial departments has expanded significantly, and also the financial departments have in a way reinvented themselves. The finance function has a critical role in helping the business being in the middle of what is changing and what is driving the change inside the business. It serves play a part in building a more sustainable future. Discussing about dynamics and rapid changes and speed of the things, how they are happening, the scope of the financial departments has expanded, being actively involved in strategic decision-making, risk management, and performance evaluation. Of course, this shift has profound implications for business leaders, especially when considering the imperative of sustainability. In the last years, and especially after the pandemic and the crisis in a way, sustainability has emerged as a critical business consideration, encompassing economic, social, and environment aspects. As financial departments take a more prominent role, business leaders must recognize the connection between financial decision and sustainability outcomes. To the lens of sustainability, this expanded role of the financial departments, and besides the expanded role of the financial departments, I would say also the reinvention of the financial departments, provide business leaders with valuable opportunities and challenges. And here I would mention strategic alignment, risk management, performance evaluation, and stakeholders engagement. Expanding the role of the financial department presents business leaders with a unique opportunity to integrate sustainability into a core of their organization. By recognizing the interdependence between financial decision and sustainability outcomes, leaders can leverage financial expertise to drive positive change. Together with financial departments, they can align strategies, manage risk, evaluate performance, and engage stakeholders in the sustainable and responsible manner. At the end, the role of the financial departments, it's enlarging in a way, because the part of accountancy, treasury, taxes, accounting, reporting, this team is becoming, let's say, a reference for the rest of the companies, because the transformation is present in all the areas of the companies together with the innovation. And this is it's increasing the importance of these departments that are becoming coordinators of other processes inside the company. Now, in order to To continue on the same idea, moving from the increasing role of financial department through the lens of sustainability, another important aspect that I want to highlight is about an alternative to everything that we were discussing. So is there integrated thinking and reporting an alternative to the organization solution in order to communicate with their stakeholders? Because going further in this world where stakeholders are increasing demand over transparency, accountability, and the holistic view of an organization value creation, integrated thinking and reporting emerges as a compelling approach that addresses these needs. And the global financial crisis highlighted the shortcomings of traditional financial reporting, including the lack of a future-oriented information and the failure to fulfill account for intangible. Today is not enough to see only the financial of a company or organization. The financial package is giving you a history and a hint over the past. We need to have direction for the future. And integrated reporting is trying, let's say, to mitigate this requirement from the stakeholders' side. Companies currently are publishing standalones on social and environment reports and provide such an information in separate sections in their annual reports, resulting in a social and environmental disclosures being disconnected from financial part. This fragmented reporting fails to capture the connectivity and synergies that exist within organization, limiting our understanding of the true value that an organization creates and the potential risk that is facing. The scope and the purpose of integrated thinking and reporting is to overcome this limitation by adopting a more comprehensive and interconnected approach. Integrated thinking and reporting enable organizations to demonstrate their commitment to sustainable and responsible practices. Moreover, it's fostering a culture of accountability and encourages organizations to continuously improve their sustainability efforts. Because we were discussing about continuous improvements and innovation. These are part of the sustainability force package, I would say. It encourages organizations to view their operations through a broader lens, recognizing the interplay between financial, social, and environmental aspects. In the same time, it encourages a shift from short-term thinking to a longer-term perspective, incorporating sustainability consideration into decision-making process. The feasibility of integrated thinking and reporting lies in its potential to provide a more accurate and holistic view of an organization's value creation. And today the emphasis and the accent is more on value creation at level of organization. Value creation, transparency, accountability. To make integrated thinking and reporting a reality, so to be adopted by organizations, of course, companies must cultivate a culture that values transparency, collaboration, and long-term thinking. They need to invest in systems and processes that capture and analyze relevant data across different dimensions, different areas. They must engage with stakeholders to understand their expectation and incorporate their perspective into the reporting process. In conclusion, integrated thinking and reporting represent a feasible alternative to a fragmented reporting approach. And by embracing this approach, organizations can unlock the potential of their value creation, address sustainability challenges, and contribute to a more sustainable and inclusive future. So we need, from our position, to be aligned with what is happening in day-to-day life, meaning the increased speed, digitalization, innovation, emphasizes of sustainability. Companies must adapt to these changes and also to reshape their internal processes in order to fulfill stakeholder needs. And of course, we have the tools, but we need to be open to embrace these tools. So let's seize this opportunity to reshape how we think, report, and create value. Of course, in the benefit of our organization, stakeholders, and society at large. Thank you.
Thank you very much, Mariana. I have just, we're slightly over time, but I just want to ask you one quick question. So, you know, you mentioned about the short-term and long-term goals and values that needs to be created. But, you know, I think that nowadays the world is going through very rapid changes, I would say, and changes that affect all kinds of sectors and industries and companies. So I think that some companies and employees, they struggle to see the big picture, kind of, you know, when you have these kind of issues facing you on a day-to-day basis. So I guess my question to you would be as to how can you maybe balance these perceptions of the big picture, having the big picture in mind, and also not being overwhelmed with the short-term issues. I think especially the CFOs right now are under immense pressure, given that, you know, the economic situation is very unstable. There's a war happening. There's also digitalization ongoing. So I'm curious to hear what you think about this.
No, for sure. As I was mentioning, the environment, it's in a continuously movement. So, but I believe that regarding your question, we need to split into the problems, because discussing about sustainability, we need to see the matter of sustainability on long term. You cannot become sustainable starting tomorrow. And sustainable action and sustainability, it's a strategy that is not necessarily cheap, it's costly. You need to allocate budget, and also the results are not on short term. You are going to see the results in 1, 2, 3, or 4 years. And I'm giving you the example of the CO2 emission actions that companies, let's say, are trying to implement. So this is a long-term and long-run objective that, of course, and requires a lot of investments. Then on short term, I believe that here we need to see the part of how we adapt to the changes. Because if the war is on our border, we need to react and to adapt and to redirect and to have new strategies at company level, because you cannot stay and to expect to have the war closed. So I believe that we need to see the problem from different angles, and in a way to have long-term sustainability actions that in a way we need to connect with the part of the financials. But on the other hand, we need to adopt and to react to what is happening currently, to adapt to the new processes, but in the same time to enhance a strategy on long term. Because you cannot see only, because the short-term gains, as I was mentioning, the quarterly, the annual profits, you need to think how to reinvest them in order to construct a sustainable business, because we are discussing about sustainable businesses. And here we can discuss a lot of factors: innovation, digitalization, embracing the part of the environment and social action. But in the same time, the part of flexibility and adaptability, it's crucial today, because we are not anymore players in a stable environment. So I suppose the flexibility and adaptability, it's our key drivers.
Yes. Thank you very much, Mariana, for your presentation and for joining us here today. Thank you.
Thank you also for the invitation. Thank you.
Okay, so we are moving to the next session and the final session of today's webinar. It's a panel discussion, which will be moderated again by Vladislav Sitnikov, who you saw earlier, the Vice President, Treasury and Wealth Management QA Senior Manager at the Global US Bank. And the panel discussion topic is the younger generation, or Gen Z, as they enter the workplace in finance. Vladislav, over to you.
Thank you, Peter. Hello, everyone. For those who haven't joined earlier, I'm regional manager for EMEA region. Natively, I'm from Ukraine and living in Poland for 6 years so far. And I want to welcome to our discussion. And today I have a privilege moderating a distinguished panel of experts who have a wealth of experience and expertise in the finance industry. Peter Toman, Chief Risk Officer and Vice Chairman of the Board of Directors at MONETA Money Bank. Livia Hilmas, Head of Accounting, Tax and Risk Management Country Group, Romania, Moldova and Bulgaria at Bayer Company. And Dmitry Murdic, National Financial Director, CFO at Connectiva. Their insights will provide valuable perspectives on the challenges and opportunities presented by the entry of Generation Z into the workforce, as we'll explore the influence of young talent on companies, the radical differences between millennials and Generation Z, and the development of tech-savvy executives. Our panelists will offer their unique viewpoints based on their roles and accomplishments within their respective organizations. And in our increasingly dynamic and digitally driven world, understanding how the younger generation impacts the workplace is crucial for organizations to stay ahead. This discussion will help to deep dive into the innovative ideas, digital fluency, and distinct characteristics that Generation Z brings to the table, and we will explore strategies to attract, retain, and motivate young talent while developing the necessary skills and competencies for future leaders in the finance industry. Together, we will gain valuable insights into the evolving landscape of the workplace and discover practical approaches to harnessing the potential of Gen Z talent. So let's begin our engaging and enlightening discussion. Very first question about how young talent influences company. I want to ask, how have you observed the impact of young talent on the risk management practices and overall success of the company? Let's start with you, Peter.
Hello, everyone. Thank you for inviting me. On this question, I think that it's very important to understand what risk the company is facing in the current environment, and the fact that the risks are changing significantly, and the fact that we are basically speeding up in the process of discovering new risks. We also need to adjust our hiring process to have people on board who not only understands the risk, but also are somehow familiar with the risk. So by that, I mean, if I take an example of a cyber risk, which is right now quite significant, and a lot of the CROs are actually mentioning this as a risk number one, which we will be facing in the near future. It's somehow tough to expect that people from the older generation will be able to work with such risks in a way that they will be able to capture the entire scale of the potential threats we are facing. So for that one, I think that it's extremely important to actually embed into the risk culture and risk organization people who are from the generation where usage of all the IT tools and the risks connected with usage of all the IT tools are natural for them. Because in case they will be not natural for them, it's going to be very tough to quickly adjust and mitigate all the risks. So that's, in my point of view, it's the very important aspect, and the fact that we need to consider, and that's why we need to work with the Gen Z.
Amazing. Thank you, Peter. Livia, please share your perspective.
Yes, and before starting, I would like to mention that I fully agree with what Peter has said, and maybe just a disclaimer before that. I would like to share that I work with Gen Z, but the Gen Z just at the border between millennials and Gen Z, you know, the ones that maybe they are contaminated also with some past influences. So in interaction, you have to view it from this perspective. But I totally agree with what Peter has mentioned, and this influx of young talent can bring really fresh perspectives and innovative ideas in our risk management practices. And I'm saying this from the point of view that they often, not always, but they often tend to have better understanding on, like Peter has mentioned, cybersecurity, or Mariana has pointed out this sustainability, so the climate change risk. And also, if we are speaking about social media risks and everything that comes with digital world. So from this perspective, the young talent could really come, and they are really coming and influencing, because we see a tendency to have everything on a click button, everything to be agile, fast, and so on. And they expect, and you know, it's like we were discussing a lot about challenging the status quo, but they are coming like bam, like that. So they are questioning everything that when they are coming into the company. Why are you doing that? And so on and so forth. So from this perspective, really the companies should see this opportunity. And like in any generation, there are of course talents and some members that are putting a lot of effort, but you know, companies should prioritize the professional development of young talent, because definitely they can benefit from the skills. And just maybe a very punctual example, so a real life example, and once again, the disclaimer, it's between the generations. I have in my risk management department a very young talent that we have recruited from the university. So she was in the first year in university, and we started with some internships, and in order to get some support during the summer. However, it turned to be a talented colleague with a promising future, and together with her, because it's a lady, we have developed nice tools. So we saw that there are, as I said, processes that were not necessarily agile, and we have shifted them from paperwork, decentralized, and so on, into digital tools. And the colleague has seen tremendous growth in the company. She's very well seen, and of course recognized for her input. So I have a very good example dear to my heart. So it started from my department, and yeah, I'm very glad that we have her in the company.
Great. Thank you, Olivia. Peter, could you please share your experience of this?
Greetings from my side as well, to my fellow panelists and to everybody joining the panel discussion. Well, I just want to touch a little bit on the general risk tolerance and the impact to risk management of the Gen Z. I think at the end of the day, they are not too much different than what we were when we were starting. So they don't have a lot to lose and they have a lot to gain. So they are quite more risk tolerant than we are, and sometimes don't see behind the corners as we do because of the experience. But at the end of the day, this is very valuable input, and the experienced senior manager can actually gain from listening the input given by the Gen Z in this more risk tolerant way. And the mixture of two opinions always gives the better decision at the end of the day. So the perspective is very much different. for a reason, and that's completely normal. I think we had it as well when we were starting, and us as leaders, we just have to take it into account, and it's going to improve our decisions for the risk management of the company, definitely.
Thank you, Peter. Thank you. We'll bit already touched this, but still maybe we can talk more. How can companies leverage the digital skills and familiarity with technology that Gen Z brings to the table to drive digital transformation? Livia, maybe you can a little bit add to your previous point.
Yes. So what I can say that, of course, we all know that this Gen Z is the first generation that really grew up completely immersed into technology. The previous generation, the generation that I'm from, you know, we were just growing up in a world that the technology was developed, and of course there are some kind of differences. I would say that the Gen Z, although so they grew up, and I like very much what Mital was mentioning, that it's not like there are so big differences and so on, and maybe we were also like that. I would say that what Gen Z has, it is a digital mindset from growing up with technology already done. Maybe not all have full digital skills, let's put it like that. I recently read a study that was done by Dell, covering 15,000 Gen Z participants within 15 countries, and they also, so although they have this digital mindset, they feel that they lack some of the skills. And here I do believe that also the university should do more for this area. However, what I'm trying to say is that the digital mindset is there. And of course, you, in any generation, you could have more skilled in technology and so on than others, but the digital mindset is there. And I do believe that this is the foundation of also what I was mentioning previously. And because, you know, this digital mindset exists, and everything, as I said, should be readily available, it should be viewed. Mariana was also mentioning that the data should be captured from different angles, and this aspect comes with Gen Z and the possibility to contribute. So really, companies should leverage, and I saw that a lot of companies are leveraging this mindset to drive transformation and remain competitive, because in the end, if you are not really that deep diving into technology, you are not competitive. And in finance, just a very simple example, like, you know, in the past, somebody stood there, took invoices, physical invoices, and they inputted data by hand. This cannot be done because this is not, in fact, competitive any longer. We have robots for that one, and so on and so forth. So going in the digital mindset is absolutely essential, and young talents could help adopt this agile methodology, streamline processes, and also leveraging the technology that they understand best, like artificial intelligence. So this is my view on the digitalization.
Thank you, Olivia. Well said. Especially, I also like your point about universities, which also need to be in line with our current reality. Thank you. Peter, would you add on this point?
Yeah, I think that I would just follow on what Livia said with the mindset, with the digital mindset.
Seems we lost Peter for a moment. Maybe while Peter, yeah, please, Livia.
No, we were discussing about technology. You know, sometimes the technology is not, you are planning, but not always it works out. So flexibility, we should be flexible.
Yes, fully agree. So maybe we can be flexible and switch to meter. meanwhile?
Yeah, before we lost Peter, I definitely heard him agreeing on the digital mindset of what Livia said, and it's definitely the most important when it comes to leveraging the technology and the knowledge of the Gen Z coming into organization. If I may add to this, something that I noticed plays a very interesting and important role is the simplicity of view the new generation have. So oftentimes, you know, when you're designing a new solution for your process or for your department, and then you send it, for example, to legal or to compliance to check, and it returns 4 times lengthier and less elegant than you imagine it because of the procedures. So Gen Z have this very simple view on problems and on solutions as well. So oftentimes when they are fully involved in any kind of innovation or business development or marketing campaigns, they will propose a very simple, cost-effective, and solutions that simply work. So this digital mindset helps them to propose the solutions much simpler than people working for ages in the departments and teams of corporate firms. And as well, since they are fresh from the university, the improvisation and the low budget projects are their mindset still coming fresh from the university. And this really helps push through small improvements in the teams, in the efficiency of the teams, as well as bigger projects as well. So that's I think what they can bring to the table, definitely.
Thank you, Mitar. I like your point about the fresh view which they can bring, and especially interesting that it's very cost effective, which everyone would love to have, of course. We have better back.
Sorry for that. That's why we need the Gen Z, because if you don't have them, then you have this IT issue, which I just experienced. No, but coming back to what I wanted to say, hopefully it was not said by Mitar, but following what Livia said on the digital mindset, I think that this is the crucial thing, because for me, the banking products, we need the user experience of the employees with the products which we want to sell. And as we are approaching really the fully digital era, with people which are not surrounded with digital from day one, they born, and which don't have the digital mindset, it's very tough to give the user experience to the clients. One example for all. My boss, the CRO of the whole group, he's 60 years old, and he really does not have the digital mindset, and he's kind of an old-fashioned guy. And working in the digital bank, you know, without being surrounded with people which do have the digital mindset and are able to explain to him that actually the digital things are valuable for us, it would be really tough to move the company to the next level. So just by that example, you know, the excos, they sometimes do have a mindset that I know it all, and we actually need to convince them that with respect to the digital and with respect to the new technologies, they don't know it all, and we need to leverage from the UX and digital mindset, which does have the Gen Z.
Thank you, Peter. And I believe our audience would love to hear the radical difference between millennials and Generation Z. In specific, what are implications of Gen Z as a desire for work-life balance and flexibility on company policies and practices? Mitar?
Yeah, so work-life balance. If all of us don't have a good work-life balance, that's failure on us, isn't it? Not on not the Gen Z is asking for something more. I think it's more linked to a post-COVID time than the Gen Z, but they are actually entering the organization, so we are often automatically linking these requirements to them. But everybody joining the new organization will have certain expectations, let's say, when joining in post-COVID times. Certainly Gen Z helped push this norm, but also the circumstances were going into the favor of basically tipping the scale to more to the approach that favors more the better work-life balance. But I think it's the responsibility of each individual to set the work-life balance for themselves, and also senior management to set it for their teams. As I said, certain things in last 2 years became a norm, and us in our organization certainly have to be aware of that and set the trends. So we shouldn't be stuck and say, now COVID is over, we go back to our own ways. The evolution of work is continuous, so we have to follow and not let being pushed by Gen Z or anybody else whatsoever. So set the example with yourself, with your team, and just follow the trends and set the new norms.
Well said. Thank you, Mitar. Livia?
So my view on this is for sure Gen Z places a high value on work-life balance and also on flexibility, especially on flexibility. And I will not repeat, because I totally echo what Mitar has mentioned. I will now focus on flexibility more. And what I see is that the Gen Z, although the pandemic started and so on, they have had more demands, and here I'm wanting to say, so it's not only about working from home or in a hybrid way, but they ask now to work from everywhere. And here, when I'm saying everywhere, is not within the boundaries of one state. So they would like to be like very, very free. So to have the liberty to move around based on their desires and to work from everywhere. And with this working from everywhere also comes the flexibility in the schedule. 9 to 10, 9 to 5 is not working anymore for them. 9 to 10, 1 hour would be maybe, but so also from the location point of view, some differences in hours and so on, but really they want this flexibility to another level. Also, what I saw is that they expect that something should be changed in the working place related to the schedule, moving to the 4 days per week. So to have even more time for themselves with the work-life balance. So I do see that they are coming, and once again, it's not only Gen Z, because also the expectation comes from also the other ones, but I see that they are more vocal. Let's put it in this way. And of course, some of their requests can be accommodated. Some, unfortunately, we need still to see the reaction of also implication, let's say work from everywhere, implication from the tax perspective. The world is not ready now to work from everywhere. So there are limitations from this side. However, I do think that we are moving towards that direction.
Very insightful, Livia. Especially from taxes perspective, it will be a big headache for everyone. Thank you. Peter, what is your view on this?
Oh, there is not too much to add, because Mitar and Livia summarized it really well, also with the examples. But maybe just one thing which we do experience, and where I see that we still need, or we are still not able to be on the same page as those who are approaching us recently from the market. and that's it's not only working from everywhere and working whenever you want and basically adjust the working routines to what I like, not to what the company like, but also it's working from myself. Because what we are right now experiencing is that, you know, people don't want to use pen and paper. They don't want to sit in front of the laptop because you need usually some connection from an external device. They want to either have a tablet or a cell phone from which they are able to basically manage everything. And yes, if you have the position where you can have calls and you can do stuffs which do not require some writing and managing stuffs in the systems, it's probably valuable. But if you really still need to use the computer for, I don't know, designing or coding or whatever, I think that on that one, this is exactly the border which we will probably never cross. But it's also this fact that basically working from your cell phone, from whenever, wherever and whenever, this combination is coming, and I'm pretty keen to see whether it's going to be successful, this working mode or not.
Many thanks, Peter. Next question is, Livia, how have you adapted your leadership approach to effectively engage and motivate Gen Z employees, considering their distinct characteristics and preferences compared to millennials?
Yeah, so here I think that there were some aspects done, but there are still to come. As you know, we are at the beginning of working with the Gen Z. However, in order to effectively engage and motivate them, we need to understand what are their, you know, desires, characteristics, and preferences. And of course, we already discussed about work-life balance and implementing hybrid or remote work and flexible times, so working at any hour, irregular hours, and so on. We even have a disclaimer: I'm sending this email whenever suits me. This doesn't mean that you should reply immediately. So we have implemented this as a corporate disclaimer. What I have noticed related to the Gen Z is also that they tend to look very often to quick growth opportunities, development opportunities, and they want to be mentored in an environment where they can advance quickly or they can receive ongoing feedback. And I do believe that in the last year, we have moved away from the annual goal setting with annual performance evaluation. You know that in the past there were very big annual events, let's put it like that, into a more agile approach in order to really satisfy the expectation of this generation and the expectation of the world as is moving forward. And we have now shifted from this annual recurrence to quarterly setting of goals with more check-ins and of course ongoing feedback. It was in any case, but really implementing the agile approach of things. After that, I said that they are looking for the quick growth opportunities, and here I'm referring to implementing as a company opportunities to learn and develop in a non-academic way, let's put it like that, in a more education shot, let's say like this. And we have implemented in the organization programs, unlimited access to learning opportunities like LinkedIn Learning, and the colleagues can really go and go tailored on what they desire to learn, having very short programs and going into the direction of growth on the moment. So offering them the possibility to develop, offering them feedback, offering them mentoring, this is what we were doing and I was doing with my team.
Thank you, Olivia. Peter?
Yeah, I think that, you know, for me, it's, and Livia mentioned it, it's for me, it's more from, you know, giving, I don't want to call it orders, but giving tasks and hoping that it's going to be somehow, happening and people will know what they do, to giving tasks and then explaining what I want and then guiding throughout the process before we reach the period where the person understands the full process and somehow can work on their own. I think that for me, this is the biggest difference because, you know, in the past days or with the people who are older, from the older generation, we always wanted to prove that we know how to do things and we've been more creative ourselves in delivering. However, the Gen Z, at least for me, they want to make sure throughout the process that they are doing how we expect, and hence they need the more direct approach and more direct leadership. I think that it's not a wrong thing. On the other hand side, you know, what I experience also is that once they achieve that they are able to work independently, they instantly think that that's the time to move on to the next career level. And there I'm also struggling, and I need to be really tough on explaining that, you know, you need to live it through before you can move on. And really, like, you know, being the CEO in 5 years, that's a fairy tale which you can see in the television, but in the real world, usually this is not happening unless you don't have your own business. So that's for me, like, you know, the change which I needed to do in my head to basically talk more. It sounds very easy, but it's like that. Talk more to the people and understand more how they feel at this very moment and how they feel about the work they do in the very moment.
Thank you, Peter. Very insightful. So definitely agree on your points, and especially that they want to hear not only tasks, what to do, but they want to understand why it is needed. Thank you. Peter, what is your view on this?
Interesting to see that the companies are approaching and accommodating their needs in a very similar fashion, from quarterly review meetings and learning platforms, etc. We have something similar in place, but not to generalize too much. Of course, there are low and high performers in each generation, but I would just focus a little bit on the higher end of performance when it comes to Gen Z. And what I noticed and what I really like is that they want and have a willingness to learn about the whole process, the whole organization in depth. So they are not afraid to change jobs very often, not in terms of the company. I'm not talking a lack of loyalty here, but just willingness to risk it a little bit more, let's say, and change jobs within the organization to be able to learn more. And quite often they are very willing to enter even job rotation. So certain programs we created where the younger generation can enter into the job rotation and also location-wise rotate. And these people gain the knowledge about the business and about the organization much quicker through these ways, and they are able to contribute in a more value-added way before compared to if they were just sitting in one place and doing one job. So from my side, the job of the leadership is to listen, to hear this need, to try to accommodate if your organization is big enough, is flexible enough to accommodate something like this. Because at the end of the day, by doing so, you're creating some future leaders, right? You're creating people that will lead your company in the next years. So it's very, very nice to see and very reassuring from my perspective.
Dimitar. And the next item which I want to talk about is when we talk about tech-savvy executives, what specific skills and competences do you believe are crucial for developing tech-savvy executives in the finance function? And how does the company facilitate their growth in these areas? Dimitar, maybe let's start now with you.
Yeah, specific skill for the tech savvy executive. I think that there is no specific skill. So there is a set of skills certainly that is more handy or more useful than the others. But I think the recipe for staying up to date in general, so not only tech savvy, so in innovation, human relationship, market, business as a whole, and tech as well, is just stay curious. Like when you were a child, be curious about new things, be curious about changes, and be very, very well informed. So that doesn't mean you just follow the latest accounting updates and standards published in your country or worldwide. I mean in general. So people are doing wonderful innovations and changes around the world across industries. So one innovation in an industry completely not related to yours might trigger a very nice idea to implement in your team, your company, your industry. So be curious and very, very well informed are two things that I find crucial in staying relevant in general. And at the end of the day, as an executive, you have to have free time. Free time is very important. To have free time to think, to draw your future strategies, to think through your future moves. If you're fully operational, have no free time, then you're never going to be a leader of a future. You're going to be stuck in a pile of work of present and never be able to build a company of a future. You as a leader, your job is to create a free time for yourself, to create a team that is self-sufficient, and then only then you can contribute in a proper manner as a senior leader. So that's in general, maybe not so specific skill, but general set of skills.
But still, I believe very good points. Thank you.
You're welcome.
Peter?
I would just add to what Mitar said, delegate, because if you will not delegate, you will have not the free time, and you have to trust to the people you are surrounded with, and you have to trust the data which you are working with. And as I mentioned in one of my previous answers to one of the previous question, as an executive, you cannot have the mindset that you know it all, because that will basically kill you, because you will be trying to be in control of everything, and this is not the leader of the future. You really need to trust and delegate, otherwise it's not going to work.
Fully agree. Livia?
I'm thinking what to add, because what can be further done. Of course, I totally agree that you need to be curious and to explore what is happening. It is very important to be mindful of the role of the technology plays in the area that you are acting. You need to have time to think for the future. You need to delegate. So these aspects are essential. Maybe I can add, you need to be connected, networking. Find time to network. Networking can be a very insightful mechanism that, you know, can have an important effect on the future and how do you see the operation, the vision, and so on. So networking, I do think that it should be a skill for the leaders, and it should take advantage to the fullest.
Brilliant, thank you. And the very last question on my list, and we're a bit overrunning, so I would ask you to be short if possible. What initiatives have you implemented to foster a culture of continuous learning and upskilling among your team members, particularly in terms of leveraging technology and digital tools? Peter?
For me, it's the knowledge sharing of the team members to the others, because if you have people who are willing to share and understand something what the other team members don't, it's always good to develop also their knowledge sharing skills by just sharing with the group of people they know, and by that you are able to develop people who are not afraid to talk, to stand up and show what they can do and what they can bring to the table. So for me, that's the point number one, which I'm trying always to implement.
Thank you, Peter.
Yeah, well, in order to create a culture of continuous learning and to create this motivation, at the end, as the end result, you have to reward and recognize skill. So yes, we earlier mentioned we did also as an organization implemented industry-leading platforms that are allowing our team members to have full access to online courses and learning sessions. And I think very important is that not really related to the business they are doing. So in general, I just said in the previous point, be curious. So we are valuing people that are curious, and they don't necessarily have to learn about their current job, but the wide knowledge will give them a perspective, and this is what we are valuing. So language courses, learning platforms, cross-skilling as well. If anybody have a will to do cross-skilling and is interested to learn what other team members are doing, we are promoting this, and also international career opportunities. Whoever feels flexible to explore our wonderful world through our company, we are embracing. So these are all tools we are actively using. Somebody prefers one over the other, but it's important that at the end of the day, you recognize and you reward somebody who is willing to learn, and somebody who is motivated and self-motivated to learn.
Well said. Thank you, Mita.
You're welcome.
Yeah, and because we had we already discussed with Mitar, so we had more or less the same project in our companies. Maybe I would add some more that were not discussed. I'm not saying that they are unique, but and related to the skills that Mitar was mentioning, maybe not necessarily in your area. We have implemented a very cool platform with projects that offers the possibility of employees to apply for a short-term assignment in the sense of working for another department. And there you have, it's an online platform. Any department can introduce their projects with some descriptions and how much time would you see that you need to allocate 10%, 25%, 50% of the resource time and so on. And with this, what we have in mind is really to upskill cross departments. So to have these talents have access to real life development besides the theoretical one with the online platforms for learning, but also real life experience in also other areas. And this is one. We have also implemented an advisory board panel concept of young talents, advising more senior leaders on topics, general topics that could, sharing their unique view on different aspects that are running in the company. And I don't know if Mitar or Peter was mentioning, when you have two ideas, for sure, out of these two ideas put together, it will come the best idea in the end. So these are just few examples. We have more because we are very passionate about this. And of course, we still have a lot to do. So we are in progress with. But what I would like to say is that really continuous learning and upskilling is crucial in today's environment.
Great, many thanks, Livia. With this, in closing our panel discussion on the younger generation, Gen Z, as they enter the workplace, has provided valuable insights into the impact of young talent on companies, the distinct differences between millennials and Gen Z, and strategies for developing tech-savvy executives. I want to thank you, our esteemed panelists, for sharing their expertise and perspectives. And I hope that the discussion has provided valuable guidance for organizations navigating the challenges and opportunities of the modern workplace. Let us embrace the potential of Gen Z and work together to shape a future of innovation and success. Thank you. Thank you a lot.
Thank you very much.
Thank you.
Thank you very much, and yeah, I want to thank all of you, Mitar, Livia, Peter, and Vladislav for this great panel discussion. It was very insightful, especially for us as well. Thank you.
Thank you so much.
Okay, so dear viewers, so that was the last session of today's webinar. Again, I want to thank you all for connecting and watching this webinar, and I really do hope that you found this webinar insightful, beneficial, informative, and that you can basically, apply the things that you learned already today. Two things that I wanted to mention before we end. First one is the recordings of this webinar will be available next week. So all of you that registered for the webinar, you will receive the email with the recording link. And the second thing is that we are going to announce two big events in the second half of the year. Also in the next 1 or 2 weeks, so please stay tuned for these announcements. I do hope that you will find those interesting for you, and you will join us for these two events that we are about to announce. So again, thank you very much for connecting. Stay tuned, and hope to see you all